So, hi everyone, I'm Crystal Persaud. As Marty mentioned, I am a shareholder in the New York office of Polsinelli. My practice, my practice consists of mostly commercial real estate lending, but I also do commercial real estate leasing, acquisition, sales, and
No? Okay.
now I'd like to introduce our panelists. I'll start this way, then go this way. If you could just please introduce yourself, tell us a little bit about your company and what your role is.
Sure. My name is Gerig. I'm the CEO of Northlight Capital Partners. We are a distressed real estate credit fund manager based in Westport, Connecticut. We've raised 3 institutional funds over the last 10 years. We're in the process of raising our 4th fund. We also have separately managed accounts that we focus on. There are really 2 parts of our business. First part is buying distressed mortgages, first lien distressed mortgages, where we can close, restructure, do a discount with the borrowers. And then the second piece is we do special situation lending. Most of that is typically in bankruptcy. So we do DIP loans, we do exit facilities, we do recapitalizations, we do a lot of weird stuff. So we've done brownfield financings, things where we think that there's an opportunity. I think the other thing that makes us a little bit different is we are an unlevered fund. So we buy, our comment is we buy first lien loans at a discount on an unlevered basis. So our loss ratio is pretty low, which I'm happy to say. Otherwise, I'm really screwing up.
Hi, I'm Tim Bass. I'm from Hickory CRE Lending. We started this lending platform in 2018. I came from a hedge fund where we built a lending business and also bought a bunch of buildings in Europe. Started my career at Chemical Bank, which dates me, I guess. Some people may remember that. I'm a credit guy, but also have a legal background and approach real estate lending from a structuring and credit perspective. And we have managed accounts and have gone full cycle with a number of our deals and are looking to expand our capital base. We do higher LTC lending. We're seeing a lot of multifamily construction now. We've seen in the past pre-development. We tend to go to something like 80, 85 LTC and are aiming to get something like 70 LTV. The stretch senior market is in the 6 to 8% spread off of LIBOR, now SOFR. And with points that gets you to like a 10 to 12% IRR gross, and then we sell up an A note, or we will do mezz and preferred, which starts more in the 12 to 14%. So we're aiming for low teen IRRs and think that it's a great space because we have a cushion behind us from the equity and we're willing to stretch that higher in the LTC, higher in the leverage stack if we get credit support. So that's often a trade-off that we'll make. We've seen a lot of capital flow into that space over the last couple of years. It was much more competitive. We're looking forward to this environment where we think there's going to be a pullback of a lot of financial institutions, particularly banks who are already seeing at lower LTCs. And hopefully we'll see some broken deals too, because I have a background in distress and would love to do more of that. We're starting to see some stressed and distressed deals, but we can get into that in questions.
Hi, my name is Dino, Christoforakis. I'm the founder, managing principal of Vential Investments, a company that I started early this year after a 16-year career on the institutional side. I started in development. Then I shifted over to the private equity real estate world and later for the large institutional managers of the world. got to see a lot of things firsthand. I had a first row seat with a bunch of different things happening late cycle, with as far as misalignment of interest to a certain extent, and that led me to create this platform where we essentially co-invest and create co-GP opportunities for family offices, high net worth individuals, and like-minded institutions that have a long-term perspective in owning good quality real estate, and they're focusing on capital preservation more than anything else. We are investing across major asset classes. My background in particular has been, in residential, retail, office, industrial, across the United States and Western Europe. And we're also investing up and down the risk spectrum. So we see a lot of deal flow. First and foremost, we underwrite the sponsors and the developers that we're working with. So we really scrutinize that part of the equation. We only work with the best and the brightest, people that have similar beliefs like us. They are very disciplined, which I think extremely important nowadays, and we can talk about that later on. And we're looking to capitalize on the opportunities that I think are inevitable in the next couple of years.
Great. Can you give us an example of some of the deals that you're recently looking at or have recently closed?
Sure. So if you asked me the same question 3 months ago, I would say a lot more of the deal flow would probably be on the development side, considering that a lot of the sectors are overheated, overpriced, and have been for quite a long period of time. A lot of people were targeting development to get to that yield environment that the deal would pencil out for them. Now, obviously, with interest rate movement, supply chain constraints, labor shortage, development is getting a little bit more difficult to underwrite and make sense of it. So we're shifting a little bit more towards certain opportunistic sectors. We are focusing a lot on the fundamentals. We are paying a lot of attention on the residential sector in the US. I think it has a very long runway, given the fundamentals of where the economy and the housing market is headed and where it is today. We're paying a lot of attention on the build for rent space and the single family rentals, which I think has a tremendous potential to mirror what's happening with multifamily in the US. Namely, multifamily is about 50-60% institutionalized. And as a comparison, the SFR space, single family rentals, is an extremely fragmented space with only 2 or 3% of that sector institutionalized. The rest of it is pretty much mom and pop owned, people that own 1 to 4 homes or 4 to 10. The 10 plus is really a category that we're targeting. And we like the communities that they are amenitized with on-site services, et cetera, et cetera. But nationwide, there is a tremendous housing crisis. We think that the given interest rate environment is creating even more opportunities for people to rent versus own for a number of reasons. There's a lot of attention from the big institutions and the family office world into that space, which we're helping them get into. So examples of recent deals were master plan community in Midwest, mixed use project, almost 400 acres with a combination of for sale homes, for rent homes, and then a commercial component with a couple hundred multifamily for rent units. Neighborhood retail services, grocery store, gas station. That was a co-GP investment as well as an LP, kind of a hybrid approach. Smaller deal a few months ago on the industrial side in South Florida. That was an about $12 million transaction, and we also did another industrial transaction in the Connecticut area. That was a heavy value add brownfield repositioning play. Very juicy returns, north of 25%. So it's a little bit up and down the risk spectrum depending on the investors we're working with.
So I wholeheartedly agree with Dino on the shift from own to rent as a demographic long-term trend. And we like multiple aspects of the housing market. So built for rent, I think, is a very interesting space. We also have seen, some shift out of major cities to suburban or ex-urban locations. A lot of smaller cities, tertiary markets, have really high occupancy rates, so high 90s. And the housing stock hasn't been renewed for decades. So we're seeing some places where developers are going in and building new product and pulling people out of existing older product. So an example of that was the tertiary market in the Pacific Northwest, where we lent $34 million. It was we were up into the 80s, low 80s LTC, but we penciled into the low 60s LTV. Again, very constrained housing market. The rents penciled to comps right next door. We got full recourse from the sponsor and additional collateral, and we priced that at LIBOR +8 with a couple of points. And when we sell an A note, we'll get low teen IRRs is the expectation. So we see that kind of lending to apartment low complexity build. So it's all slab on grade stick build, easy execution, very experienced sponsor. In that case, we see that kind of deal as pretty low risk because you can comp it out very easily on the rents. And because we're going to tertiary markets and going up in the capital stack, we're able to get recourse. And in this case, additional collateral to backstop us. So we think it's pretty bulletproof credit, and we're getting team type returns.
It's great.
I'm going to sound like a broken record. We love the residential space as well. That being said, what's interesting is when I first established the company back in 2011, 95% of the deals that we did were in bankruptcy, and that market was around from 2011 to 2014. And from 2014 to 2022, we haven't done anything in bankruptcy. We just closed a deal, our first bankruptcy deal in Palm Springs. It was 1,000 units master plan community that we bought the debts, we foreclosed on the property, or we came up with a plan of reorganization to ultimately take title to the property. And we've been really active in the resi space. Nobody wants to hear about buying debt. Buying debt's really boring. So I think the point of this is to have fun. But we've been involved in lending on about 10,000 land that will support about 10,000 lots, mostly in the West Coast. I would agree with you. The migratory, there's a lack of supply of housing stock. You're seeing migratory things happen where people are moving from cities to secondary and tertiary markets. If there's one market that you guys should look at for real estate, we think it's Reno. Because there we go. We've been involved in Reno since 2011, and what you're seeing are a huge number of tech people who are getting priced out of the Bay Area, moving, operations are moving to right across the border. We've been really active in Colorado, specifically Denver. But we think, I actually am more optimistic on housing sales. What's interesting is we've been in the resi market for longer than I'd like to admit, so we actually have pretty good relationships with the home builders. We just spoke to D.R. Horton last week about this project that we're taking over, and construction costs are down 14% year over year. And so I think even though interest rates are rising, I think you're going to start seeing some deflationary aspects related to that element to it. And certainly labor, if we start going into a recession, I think that'll be, have some impact on labor costs and stuff like that. And it's interesting because you talk to the home builders and they're not buying, lots for today. They're buying lots for what the market's going to be in 2 to 3 years, right? And so, when we talk to Lennar, their perspective is, this is a great location. And we're willing to go under contract and get to the finish line, not because today's market is a little iffy. It's because they think it's going to look good a long time. And by the way, rates, we were looking at, since REMIC came out in 1986, the average rate for a home mortgage was 6.63% over the last 25 years, right? It's still pretty cheap, right? I mean, my first mortgage was 7.5%, so I'm looking at 5.5 being pretty decent. So, but I agree with you guys. I mean, I think the resi market there's a lot of legs given under fundamentals.
So, what is the opportunity in refurbishment multifamily? Where you get an old apartment complex outside a mid-sized city or what have you, and you beef up the appearances and the infrastructure if you have to, and then raise the rental base. So is that an area of interest to any of you?
In my opinion, I would say it's $1 million question on cap rates, right?
On what?
On cap rates, capitalization
rates,
rates.
yeah.
So given where interest rates are at now, right? Debt service coverage ratios are coming down. LTVs are coming down, meaning more equity is going to need to get deployed. So at the end of the day, you are betting on rent growth for those multifamily or either residential or any real estate whatsoever, right? So it's a question of how do you underwrite future growth? And we can argue on that all day because there's reports out there from big brokerage shops with showing double-digit rental growth in the multifamily sector for the next 1, 2, 3 years that you may or may not see at the end of the day, right? So to answer your question, it's a very disciplined approach on the underwriting and paper. When you pencil everything down, you have to be extremely careful and have some buffer thrown into your numbers.
So in that buffer, sometimes you put together an investor syndicate for that particular project. You're the lender, but they take a sort of a more sort of equity, if you like, an equity type position, so that your exposure is not as big.
I mean,
I guess my perspective is I think there's so much competition from multifamily operators, value add multifamily guy. I mean, if you throw a stick, you'll probably hit 2 or 3 of them. And I think that the challenge that you have is the reward that you get for doing the work. This is self-serving, so I want you to appreciate that. I mean, I look at it, credit as being much more attractive in terms of what the expected yield is versus being the equity guy who's behind the 75 or 80% loan.
yeah, I mean, we look at a lot of these. We think they're priced to perfection on both the go in and exit and the value add. We're seeing deals where people are buying in at sub 3 caps and they're looking to exit in the mid 4s, and we think that's going to be challenged. We see people with very precise exit financing assumptions, which are wrong now, right? So that market shifted. That trade's probably 7-10 years old, I would say. So the stuff that's for sale is highly competed after, and I think frankly, people are clipping fees on the equity. So I think you have to look at the alignment issues because you see a decent amount of the operators with very little skin in the game. So we're not doing 80-85% LTC on a go in sub 3. That's an easy no. in this environment.
Debt guys don't understand three caps. Is that a fair
Equity
statement?
guys don't understand that either.
Yeah.
Yeah.
We were looking at a defaulted loan in Connecticut on a multifamily, and they were talking about the guy who was showing us the deal was like, oh, it's valued at $750 a foot and a 3 cap. And I'm like, this is Stamford, Connecticut, man. This is not New York City. And I just looked at him and I said, I can't even. I'm nowhere close to what your expectations are, and I think it's going to take some time before. There was so much money that was raised with the COVID trade, right? And the COVID trade really never happened to the extent that people, you look at hospitality or something like that. And so I think there's a lot of dry powder that is still desperate to, it's now 2 years and they've just been sitting on capital. And I think that there's a lot of desperation to get that money out so you can start collecting fees and things like that. But that's going to work its way through the market.
By dry powder, do you mean like money in real estate private equity funds?
Correct.
Ben's hoping that trade persists for a while.
Yeah.
Some of the multifamily value add groups that I've spoken to are baking in like a 50 to 75 basis point back up in cap rates. That seems to me to be low.
It's low.
Is that a low?
It's low.
That's okay. That was my impression.
Yeah, we unless my sponsors underwrite the exit in the 6s, we're passing on the deal.
Okay. Good.
And that goes back to being disciplined, right? And I think that's very, very important at this point in time, because it's the market is very fraught, and it's been like that even before the pandemic. That dry powder phenomenon we've been experiencing. I mean, I was working for a pension fund, a large global investment manager, right? The amount of money that we raised was off the charts,
Right.
and a lot of those people, they have the pressure to get the money out, because if they don't, it's going to go to the even bigger boys, right? The Blackstones of the world. And a lot of it is fee-based. So you're making rash decisions in some instances so you can keep the lights on and keep the machine running. But you're doing that, it's a detriment to your investor base.
I really don't know enough about how real estate private equity funds are structured, but are most real estate private equity funds structured to be capital on call or capital under management when the fund is raised?
Capital on call.
Yeah, but I would say there's not much dry powder there. This is the right deal.
Well,
I think there's a lot.
People just pull back and say we're not investing.
I think there's a lot of. I think no, it's not. It's not non-discretionary.
I'm not saying that. I'm saying
they can call. I mean, if they've raised a $20 billion
In
fund,
2009, people pulled back and went to litigation. That's what happened in 2009. People litigated instead of letting their money get called.
part of the problem is the real money guys are willing to hold through a cycle, right? So rent growth has bailed out a lot of these deals, and I think that people are going to look at it and say, 10 years from now, I'm going to be okay because of the demographic changes and the housing shortage. So I think there'll be that support behind it. But yeah, I think to Dino's point earlier, I think rent growth is pretty unpredictable from year to year. So we have to underwrite to 0 rent growth.
What's problematic about all these single family funds, these funds that own single family homes? Like, do interest rates impact them? I mean, they have.
I hate that business.
What's that?
I hate that business.
No, that's what I'm asking. Why?
Yeah, well, listen, I appreciate, there's a ton of money raised for that, but
That's
I
what I'm
mean,
saying, right?
just the aspect of managing, the nice part about an apartment building is you have one property manager that's going around, you have common landscaping and stuff
Exactly.
like
There's
that.
economies of scale.
And what ends up happening is you have a lot of guys, developers, and we've worked with a home builder out in Arizona who's gotten into that business, and their goal is, I gotta get this thing built, I need to lease it, and then I can do a trade with one of these massive institutional guys at a 4 cap. Eventually, that musical chair, in my opinion, is going up because cap rates are going to go up, and as interest rates go up, cap rates go up, and I think nobody really understands it's a new phenomenon. No one understands the cost of managing the assets. And then I think the second piece of it is you're renting a house. And I don't know whether any of you guys have ever, when I was a kid, I used to have to deal with student rentals and homes and watching them trash the homes.
A lot of work.
It's a lot of work, and there are a lot of reserves. And these homes, if you see them how they're built, I mean, they're building these homes and they're just terrible. And so I think the reserve costs that a lot of these people are assessing, particularly in like 5 to 10 years, I don't think that they will have reserved enough money to improve upon what the situation is. I could be completely wrong, but I rail against the build for rent.
No, it's interesting because we've been in this zero, credit environment, zero interest rate environment for at least 10 years or so. But, pretty close to zero, right? And now we're going in an environment which isn't that, and
But
it's great to
still-
leverage up and buy
But
assets.
it's still negative interest rates if you compare it to inflation. I mean, I think inflation rates are understated, right?
For sure.
And you're 5.5%, what are they now?
6, of course. It's 6.
That's
Right,
still
but that
borrowing
impact-
below the inflation rate.
But that impact renters' ability to pay. Right?
It doesn't
Well,
seem
you
to
have
be.
to
I mean, well,
anticipate that.
that's because we're at the beginning.
Right.
It definitely
I
does.
mean-
I mean, home sales were down this month, like existing home sales, and in particular, first-time home buyers. So they'll feel the
Because
crunch right
wages
away.
haven't put up, I suppose you have to, your renters, if you're doing these buildings, you have to wait for the renters to get more money coming in from their jobs. In order to meet the new mortgage rates as they go up on a adjustable basis.
Yeah, you typically look at it from an affordability perspective. What's the average household income on a 1, 3, 5 mile radius, and you want to be in that 30% threshold, give or take.
Yeah.
And you also did a comparison. What's your cost to own versus rent, and whether it makes sense or not. But to your earlier comment, to a certain extent, I agree, right? If you buy scattered homes, one here, one there, which a lot of those private equity shops are doing or have been doing after the GFC, doesn't really make sense because you don't have the economies of scale. But a lot of those build for rent communities, if you build them to scale, and we're looking at over 75 homes per community at least, right? You get to those economies of scale because essentially the same or similar way of managing the community as a multifamily building.
Right.
You're just having it horizontally
It's
instead of
just space
vertically.
between the buildings, basically.
I'm just wondering about this disparity between renters and their actual income, because, I look at most renter pools as people between 25 to 35. What are those guys been doing the last 5 years? Investing in Bitcoin and then borrowing to invest more in Bitcoin, right? and now that's blown up. They got to pay off the debt that they borrowed. That's blown up, and their rent just went up by 40%. I don't know. Am I wrong?
I think there's certainly a segment of that. The other thing that I thought was interesting is I met a couple of days ago the chairman of Keller Williams Real Estate, and the observation that he made to the real estate. I would agree, home sales have gone down, but inventory has gotten even tighter. And what he was telling me was, the baby boomers who typically downsize at this point, locked in at 3%, and they're saying, I can't buy a home and get a mortgage for 6%. So the baby boomers aren't selling.
Children move back home.
Yeah, and it's one of those things where there's basically nothing happening because everybody got greedy and enjoyed the lifestyle of 3% mortgage rates. So I think there's still going to be a shortage, even though I think there will be fewer people. What do they say? Every half point, 5% of the potential homeowners or whatever it is, I forget the exact number, basically come off the market. But I also think that people are just not going to sell their house.
But I mean, so you're saying baby boomers locked in, but there's lots of people who aren't baby boomers who have bad credit ratings who took variable rate mortgages out. I mean, and they, as far as I know, the balloon payment mortgages, they are actually up since 2008. I mean, so the guys that went bankrupt in 2008, they got the credit restored in 2018, took out the same sort of mortgages. So I'm right. I mean, been forwarded for too long, right?
Hey, Marty, can you hear me okay?
Rob, we can hear you great.
Great. I just thank you for your message. I just wanted to ask a question from the online audience here. It's Rob Colorina. Could you have some panel input with respect to state and local governments? How progressive are they with respect to the return to the new normal? I think there's just a lot going on and a lot of discussion about particularly urban and inner city and their willingness to be open-minded to multi-purpose use or change of use towards senior education, healthcare, et cetera. But I think a lot of us in the audience are curious about that.
I mean, I think zoning, whether you're talking about local or regional level, state, municipality, it's one of the major problems across the board in real estate. There's been tremendous pushback from different jurisdictions, zoning jurisdictions, as far as change of use. In certain locations, it takes years to go through any reasonable rezoning effort. I'm not talking about something completely off the book, right? Even shifting from single family to multi, or even multi to single, you're getting pushback from jurisdictions. So a lot of those home builders or BFR or other developers, they're congregating towards certain locations that they're much more developer friendly. And I think that's a mistake, because we're going to see a lot of bubbles created in that space. And we are seeing a little bit of that in places like South Florida. But if there was one thing that I would ask the feds to improve, that's really the zoning on the local level, and making it a little bit easier for everyone to go through that process.
I have a question. So I'm a big fan of residential as well. I have rental properties. We have waiting lists for all of our units. We have a commercial property as well as empty. Yeah, it might be a multifamily soon. So what about the other sectors? What about, there's got to be other, and is there an opportunity in commercial for converting to residential or?
Yeah, and mixed use. Yeah.
Industrial.
So
Retail.
We don't see a lot of opportunity in industrial because it's priced so tight. I mean, it's very popular in the capital markets right now. And there's a huge building boom going across the country. So you're seeing big institutions putting very inexpensive debt on that stuff. So I guess, could there be a pullback if Amazon shifts strategy? I think the whole sector has readjusted. So I think there's a lot of demand for that stuff, but it's done in huge size. And then in some places we see sort of the off the run, like, a logistics facility that's a bit dated in LA, area. And then there's other stuff that's like old industrial that could be logistics, but I think adaptive reuse is tough. I've seen those projects get really hung up because people underestimate how expensive it is to convert. You have to really look at floor plates, design. I had a guy tell me recently it was much more expensive for him to do the adaptive reuse, which he was forced to do by the zoning because he had to preserve an old school building in order to get his density. So I think, a lot of stuff's going to have to get scrapped. I mean, people are looking at these dead shopping malls for self-storage, and some of that works and some of it is in the wrong place or wrong layout. So, and then, there are obviously a lot of other sectors, like just referring to retail. I think there's a major secular trend. There's good retail. Some of it's priced very competitively. If you have a shopping anchored or, healthy retail, it's not going to go away completely, but we're overbuilt in office and retail in this country. Question about hotel, I don't know. I mean, there's definitely been, I think, a decline in business and group travel. Now we're seeing big uptick in leisure, but they're good hotels, and we've seen people who are sort of sector specific chase that stuff. So we haven't seen it priced right in terms of both LTC and getting paid for the risk that we're taking. We've also seen some people building hotels, which I think is kind of crazy. But I mean, it's very situational ultimately.
What about retirement and senior housing?
Senior housing got hit really hard, right? Because you have especially with the ALMC, you get high turnover, and COVID exacerbated that.
Was it overbuilt?
I don't know whether it was overbuilt. Probably in some places it was, but I don't know what the sort of static occupancy was across the country on that stuff. I don't think it was like in its most unhealthy state, but now occupancy's declined, and it's very hard to market to a family in this environment, right? And you're marketing, especially with the high acuity stuff. You're marketing to the family but you're paying a very high per square foot price for that stuff as a renter. So it's a business. It's not real estate, right? Like the residual value on that stuff, and I think we've all seen bank portfolios where the occupancy dips and it doesn't work anymore, and your recovery given default is significantly lower. And adaptive reuse is hard. I mean, I've also seen some people going in and buying, really broken stuff. So there's demand, and obviously demographically, we're having a shift in population age, and so there should be eventually, but is it going to all go to the smile states? And we've seen some stuff in the Midwest that we wouldn't take the lease up risk without getting a guarantee from somebody with significant wherewithal.
I think based on our experience, senior housing, the further away we are from federal government payments, the happier we are. So we don't want, the one asset class that we do not get involved on the distress side is anything where I have to deal with Medicare, Medicaid, getting payments from the federal government, because you don't know how. There are people who know how to do it that are great at doing it, but we don't have the ability to manage that. So we actually avoid, and then to your point, when occupancy dips, you're basically toast.
Yeah, you're really dependent on a good operator.
Yeah.
For managing the regulatory environment, and people lose licenses. I mean, the state exams come in, right. Like behavioral health. If somebody commits suicide, regulators will come in and pull a license.
Right.
Yeah, so you got to be really careful who you're dealing with and the backstop. I've done behavioral health deals but we've done a lot of diligence on the managers and their track record in order to be comfortable with it.
But the one niche that I was offered an opportunity, and I'm sorry I didn't do it, but I was offered it. And it's an old idea now, but the time is very fresh about establishing condominium buildings on campus for alumni and wannabe alumni, so that they could have a very healthy, active retirement in a bucolic, pastoral university someplace that they attended and attend class and audit and babysit professors, kids, and then leave their inheritance to the campus as well. So they revivify themselves by rather than desultory sort of retirement in a place in South Florida, which always impresses me, which was fourth-rate entertainment and bad food.
To also answer your question a little bit more about the opportunities, right? Let's think a little bit about how those Class A and B institutionally owned assets are being valued, right? At least, let's talk about paper value for a second. Paper value is really based on somebody's appraisal, right? So I think appraisers in general typically take about 18 months to adjust their valuation to where they should be, right? You probably guys know that better. So a lot of those institutional investors, they've been hiding, quote unquote, behind those artificially inflated valuations for quite some time. I think in the next couple of years, we're going to see some of those valuations being adjusted. And that's where we're going to see that dead man walking that was referenced in a couple of panels ago, on the especially in the office side, because we talk about office, right? Economical occupancy in the 70s, 80s range, even more, depending on whether you're talking about class A, B, or C, etc. But physical occupancy, it's not moving north of 30%, no matter where you're looking at. And in the urban core, San Francisco, New York City, you're in the 10-20 range still. So how long are you going to be sustaining rental payments from all those users, right? And I get the story that, those big tech companies, they're expanding, taking more space, asking for their employees to come back to work. And I get the argument that you're more, creative when you're in an office environment versus working from home, and it's hybrids here to stay or not. I think this whole thing is going to eventually normalize the more the labor market gets normalized. So long term, I think in the next 2 or 3 years, we're going to see opportunities on the office space. It's a matter of when those institutions are going to realize, okay, it's now time for me to divest, and now I have a good enough excuse to do so because interest rates have moved up, right? So we're going to see opportunities on office space in the next couple of years. I'm pretty sure about that on office.
Do you guys think that you'll see? I've been making this argument in my mind, and I agree with myself all the time. But do you see a hub, and what I would describe as almost a hub and spoke, where, like, I live in Connecticut, in Fairfield County, Connecticut, and you have a bunch of investment bankers and rich guys, and they're all old like me, and they've all loved the life of not commuting in 5 days a week. And their comment was, I'll go in for 3 days a week, but I'm never going back to 5 days. I'd rather quit. And so do you see a scenario with suburban office where, a Goldman Sachs is saying, I can't get the old guys to come back in. I'll open something up in Stamford, 10,000 square feet at a fraction of the cost, and maybe I can get them to at least go into Stamford on that side. I mean, do you see that happening, or do you think that they'll just all go back?
There's been a resurrection of suburban office over the past 2.5 years, and it's been suffering with one of the asset classes that was trading in the 8-9% range for many, many years, and now suddenly it's in the 60s. So yes, there's a trend of people that want to have a satellite office in the suburbia for that same reason you're saying.
No, I think that the cataclysmic event that will change all of that migration, or sort of away from metropolitan areas into work areas in the burbs, in the countryside, is when the grid goes down and Zoom doesn't work anymore.
Right.
And,
But your point was made with Goldman, with what they've done in Palm Beach. And that's in essence what they've done. Yeah, everybody went down there, so they said, okay, we'll open offices down there.
yeah, but I'm
and that's
saying
a good
it's all
example.
dependent on the electronic communication, right? And so that's very fragile. And
You think so?
Oh yeah.
But Palm
You know,
Beach is
it's-
a good example of a tight office market. But people have made the argument to me that there's going to be a flight to quality. So like One Vanderbilt or Park Avenue is doing much better than like Third Avenue. So I think you're going to see that with people are going to, get better office space in
I
order
think it's like
to.
a productivity and convenience number somewhere, like a percent.
Right.
Like, so on a personal productivity basis, if I'm living in Ridgefield, Connecticut, or Fairfield, and I'm commuting into the city, that's like 3 hours both ways, right?
Of working time, though.
Right?
Yeah,
So
exactly.
on a personal productivity, I'm losing a lot of time. You're not really working on a train, honestly. I come in from Connecticut also, right? So from a personal, from the individual, that productivity is low.
Right.
For the bank, it might be high, right? So there's this exchange, and then the bank has to take into consideration happiness, right? If it's an important employee, that person's going to stick around. Now, I totally disagree on the innovation aspect. I don't think any innovation happens in office buildings. I think all the great ideas come outside of the business environment. Goldman, JP Morgan, they haven't innovated on anything in finance. I mean, they just have distribution networks. Right? PayPal, all the great fintech firms come outside of Wall Street.
You also have to consider the kids who need training, right?
Sure,
So that
absolutely.
I mean, I've had this
You have to learn the
conversation, but-
profession, yeah.
So when you have people who need to learn, you need the old folks like us to be there to mentor them, and to, you know, expose them to the flow. Because if you're at home, you may be just as productive, like I am, but
Right, but then you're not training the next generation.
Right.
Because especially in-
online education is mushrooming, and so why
No, I was gonna say,
not
it's not-
why not apprentice people through the media again?
Yeah, I mean, like, so banking, so investment banking is not like, or hedge funds is not like insurance yet, where insurance basically has a test a week for every skill set you could have, right?
Yeah, we're not
You're not
actuaries,
there.
right?
Right.
I mean, we're doing something that's AI, right? We're interacting with borrowers, or, so, you know, our sourcing network. So for people to absorb that knowledge base, that you can't do it over Zoom.
Yeah, I don't think
You
it's
miss facial expression, you miss, you know, minute by minute, you know, you pick up the phone and you've already out of the deal flow.
Can you guys talk about like just retail sector, you know, where do you see it at? I mean, people thought it was gonna come back in a big way, and now they're saying that because of an impending recession, all the retailers are gonna cut prices dramatically. I was just in Florida and already retailers is cutting prices like crazy. You walk through them all, right? So retailing and also hospitality, can you talk about that a little bit? If you have any opinions?
I can talk about retail.
Yeah.
I think so. We're not overbuilt. We're under demolished in retail, 100%.
Under demolished. I like that.
Under demolished.
So
I'm stealing that.
I sold myself. I take no credit. But I've seen a great run in retail after the GFC. It was a very healthy spread in retail. You had to be very disciplined and opportunistic in your approach, but there was a healthy spread. That's long gone. I think it's been gone since 2016 or so. Then from 2016 until 2020, when COVID first happened, we've only seen activity and deals making sense if it's something that's grocery anchored, and the grocery is strong, like a Publix or something like that in the Southeast. And in the past couple of years, up until recently, I've been seeing a very healthy spread in the non-grocery anchored shopping center environment, where you would have the opportunity to pick up something like a power center or a neighborhood center with a strong junior anchor, or some kind of a shadow anchor story, like a Walmart supercenter across the street, separately owned, right? Driving traffic, kind of a destination retail. Necessity-based retail is here to stay, right? And that's proven throughout COVID. People still, I don't care if you have access to the best computer or internet connection, you still, you're a creature of touching, feeling, socializing, right? You got to go out and feel the goods. That's never going to go away. And I think we're going to see a lot more innovation in that space from retailers on utilizing new technologies, AI, bunch of different names that they're way above my pay grade, but you're going to see a lot of innovation in that space, and that's going to drive further growth in retail going forward. The other interesting thing, going back to your question about mixed use, I think we're going to see those lines getting blurred going vision. That's probably a little bit more of a longer game, right? But a lot of those shopping centers that have only been 100% retail historically over the past 3 decades, suddenly you're going to see a portion of them chopped up and building resi, whether maybe this combination of resi, hotel, office, whatever makes sense, right? And I think we're going to see that, by the way, across the board. So whatever was historically an office building in Manhattan, 100 stories high, sometime in the future, it's going to be a combination of uses, right? And I think, why not? Because there's increased demand by tenants, users for having more amenities. Whether you're living in your apartment, working in the office, staying one night at the hotel, you need amenities. And in many of those cases, it doesn't make sense if you just office to amenitize a building and pay all the capital up front, unless you have multiple other uses to support that. So,
yeah, can I say that I think that the most valuable thing in the world is time.
And anything that's convenient for time management, I think is gonna work, which is why I'm so upset about the new LaGuardia Airport. Yeah, I don't understand why they, if the future of retail is airports, why don't you just like make you walk through LaGuardia Terminal to Manhattan and back? It's already a mile now to get out and collect your bags.
Yeah.
Right, you know what I'm saying? So I mean, I'm just, what, is there any retail out there that saves time? Like, nobody's golfing anymore, right? It's their cell phone, and maybe they golf nine holes, not 18, right?
Maybe Amazon Go.
We own a lot of golf courses. Golf is back.
You think so?
Golf is completely back.
Where?
Oh, yeah, because of.
Where?
COVID put people.
Where-
Where are people not going to office?
We own 8 courses on the West Coast.
Okay.
So, and we bought them cheap, and everybody is playing golf now.
People don't work anymore, right?
Yeah, people don't work. Whether that continues, I mean, now that we're done with COVID, I actually think I think there's a new generation getting into golf.
Yeah, my 21-year-old son loves it, watches the golf channel, watches YouTube golf channels. And
My investment is pickleball courts.
Pickleball's
That's
the other
another
thing.
one, yeah.
Have you tried the indoor golfing locations that you have a screen, essentially soft screen that, yeah, there's a bunch of other players and there's talking about innovation, right? During COVID, there's been new startups in that space. And they're taking space inside traditional office buildings. Because they have
like the simulators in there.
So that makes sense.
well, you have a captive audience.
Right.
You know,
We-
people that go in and out the office, you don't have time to go to the Starbucks, play golf, go a couple floors down, do your training, and then go back to work.
Get a few pints of beer and you're set.
We have a golf course in Sedona, and we were averaging 15,000 rounds which is terrible, right? We thought we would get up to 25. Last year, we were at like 38. And we're charging a ton of money.
Premium, huh?
Yeah, a ton of money for it. So I think
Do you own the
I think that's
real
gonna be
estate
short-lived.
or you own the?
I don't know,
actual
even in
business?
this area,
we own both.
you can't get tea times and prices are
Yeah.
through the roof.
I think that's today. I seriously,
I think
I'm a
COVID,
seller of golf.
I have a 19 and 23-year-old and they can't play enough.
Yeah, I went up to West Point just recently. Beautiful.
Okay, and maybe you already talked about hospitality, but any hospitality you're selling that you think is a sell over a buy?
We're not investing in hospitality.
Not interested.
There's so much money. I mean, I don't think the market is today to buy. I mean, again, we're debt guys, right? So for me to buy distressed debt, today is not the day to do it. It's 12 months from now.
Can I take a step back and say hospitality on a global basis? Because I think that people are going like to France, but I think in general there's a de-globalization movement, and I think that tourism is going to suffer as a result of that. Maybe I'm totally wrong.
This is Build Back Better, largesse, bailout money that's, I think, still circulating. I think they've said that only 30% of the money that has actually been spent. So I think you still have people who have disposable income that are traveling, but that's going to run out.
Right.
And then there's going to be a lot of sadness.
I'm thinking more like
Inflation's gonna take a while.
like Marriott, who owns like all these properties all over Latin America, right? So I think there's an assumption that Americans go there, but at the same time, there's an assumption that lots of Latin Americans go there. But I'm anticipating like a depression in Latin America because of all this US, dollar denominated debt. So they're not gonna be printing money because they gotta handle all this debt they have.
I mean, I think travel is an ordinary good, and I think as people are wealthier, they want to travel. I think we'll see consumption grow of leisure over the long haul. I mean, through recession, I think you got to be careful. I'd say also, the Hilton and Marriott are kind of part of the problem. Again, go to incentives. What are they doing? Are they owning the real estate, or are they just collecting the fees? And so their big incentive is to build, and the developer's big incentive is to build. So who's holding the risk in that trade?
It's the property owner and not the brand.
Yeah.
Interesting.
So the brands are very incentivized to build. And I think you see saturation in a lot of markets. So
What about the impact of Airbnb VRBO, things like that on hotels and.
Yeah, it's a real
hospitality.
competitor. I mean, it's not a, a startup anymore. I mean, I think, it puts pressure on rates. But again, I think you have to look at these.
Taxi owners here about medallion
Uber.
prices,
Yeah.
since Uber came out.
Well, I think what's interesting is that there's a perception at Airbnb, and we actually had somebody present in December on this, was that the perception at Airbnb is kind of a low margin business. And so there's a whole bunch of guys who are selling value add packages on top of Airbnb, like, they're adding services to it, dry cleaning services, pick up stuff, drop stuff off to make it better, and then people can charge a premium for that to try to get away from it being the lowest margin business possible.
So the thing, I don't know whether you guys are familiar with Sonder, which is a relatively new concept, but they were originally like an Airbnb, but what they've started doing in California is doing a lease on an entire hotel. So they're basically taking over the hotel and having keyless check-in. You don't get any bed service. It's basically you show up and you do what you do with a typical Airbnb. And I thought it was kind of interesting because the risk that you always have with Airbnb is the quality of what you're getting, right? So it's kind of the standardization of a hotel.
Real important, yeah.
And now you're seeing Marriott actually following the Sonder business model with the keyless check-in and things like that. And so I think it's kind of an interesting, right.
Right.
And a lot of the existing hospitality stock is built around, the professional traveling, business traveling, right? So a lot of those big, large conferences, are they ever going to get back to what they were pre-pandemic or not?
No.
That's a big question that a lot of those operators are asking themselves. So,
What do you think? Really? Because, like I go to, like Dallas has all these massive, like I think one of the Hilton in Dallas has 2,000 rooms, and they've got space to seat 1,000 people in one of their conference centers, right? And I think that,
The
they've
question
been
is,
hurting the last couple of years.
will people travel for business rather than travel for leisure? I think leisure is a more protected. So that both the hospitality and travel aspects of leisure are more protected than I think the business aspects.
yeah, I agree.
Yeah, my perspective is we're going through a birth dearth, and the people that historically would buy, we're right now the biggest population mass has gone past 55 years old in the US, right? And there's this big gap between 55 and 35, let's say, or 4 years old. That's a much smaller group with expendable income, right? And I don't think the 55-year-olds are really, after COVID and everything else, are so incentivized to travel too much.
Yeah, I mean, leisure is consumption. Business travel is cost of doing business.
Yeah.
Technology has shifted the cost of doing business. So you're still getting a gain from meeting people face to face. It's just a question of whether the incremental gain of actually being there versus doing a Zoom. So if you were going to do a client meeting once a quarter, maybe you do it once a year because you can keep up with you. Maybe you do the first meeting and then you have more meetings
Marty,
on
look,
Zoom.
your meetings before COVID were all in person, right?
Yes, right, but I mean,
But teleconferencing was available, people just weren't using it. They would get into their cars and come in from Connecticut. Or travel here even from other places. So now they're getting used to staying home and being part of the audience on the screen.
But I think, really, it's about a city ethos, which is that since we continued doing events throughout COVID, right? We started doing events back in live hybrid events in July 2020. And so it's really about what state you're in. Because we went to Dallas and Austin and had massive, and Miami, and had massive audiences. The only place which hasn't started to bounce back in the same way as everybody else is really California. San Francisco, for example, is still pretty dead.
Again, you have to look at it on the have and have nots, right? Because, the conference center in Dallas might do okay, but the conference center in St. Louis might just get crushed, right? The aggregate demand may be dispersed differently than it was.
It's just a fascinating thing, and it's hard to kind of, again, to me, the big movers today are interest rates and how much people are leveraged, right? And you guys are all talking about builders, but my understanding of most builders that they're constantly, especially if they're builder operators, they're constantly, cash poor, right? And now almost all of them many of them must be over leveraged.
Yeah, but I mean, to Ben's point, lumber prices have come down significantly, right? So your year-over-year inflation is going to look better. Whether labor shortages are going to be as much of a bottleneck, I heard the other day that people are having trouble getting parts for appliances. So like home builders who are like flying across the country to buy 20 refrigerators or 1,000 refrigerators is even harder. So the big builders are having trouble with other stuff. But eventually I think that we'll come through the epidemic in some fashion, and those bottlenecks will break and break down. And so I think that those inflation factors are temporary. I don't know about inflation expectations. I suppose nobody really does. So it's hard to anticipate that. But due to this gentleman's point, I think we're in a negative real rate environment. So
I think $5 gallon gasoline just incentivizes commuting to work. Anyway.
I think,
We got about 5 minutes.
I think we have
Sure.
our last
Marc
panel.
Hershberg, yeah.
Yeah.
Thank you guys for
Oh, I'm
inviting
only
me.
10 minutes.
Yeah.
No, I'll be very quick. I'm really in multifamily space, so I can't really find on much other than multifamily. Topaz has become, just in short, little intro, Topaz, we've become a multifamily, our niche in multifamily garden style in Florida. We were historically in 6 markets. We zeroed in on a single standalone market of being the state of Florida, took a 30-year bullish approach on the state of Florida's growth story, as well as, the housing within the growth story. So we kind of went middle of the road. We're kind of Class B, A- landlords, owners, and asset managers. We have structured with 2 leading Florida regional sponsors, one Blue Rock Premier, another one being Corridor Ventures, 2 very substantial real estate owner operators in their own right. And we've managed to amass about $350 million of real estate over the last 3 to 4 years. It's about 2,500 units across the board. And what we're finding right now is, and much to your point, there's inflation on the horizon, there's supply chain shortages. So we're definitely trying to find our way within this turbulent times. But for the most part, a lot of what we've been doing is, strategically aligning ourselves with, larger contractors and GCs who have already warehouses and have the product already here in the U.S. So a big part of our decision making and going into which GC is going to run which project, where it's never been this way before, is who has the supplies and who has, who's able to move. Because speed, most guys can compete on speed. But when products aren't being accessible, that's when we start running into problems.
Where in Florida are you? Orlando?
So we're central and northern Florida. We've actually stayed out of South Florida since 2017 because we believe it's highly overinflated from a pricing standpoint. We can't make sense of it. And the primary reason is your tenant profile in central northern Florida isn't too much different from the same tenant profile in South Florida, yet the South Florida guy's paying, if not 2x on his rent, close to it. So it just didn't make sense to us from a tenancy standpoint. The guys you're underwriting on the leases are not underwritable at those rental rates of $2,500, $3,000 for Class B, affordable, quote unquote, type community, or even market rate for that matter. So we basically focused on central and northern. We've been in almost every major market in central now, everywhere from the Space Coast, Orlando, Lakeland, Tampa, the whole way through. And Yeah, all through the I-4 corridor, if you will,
I-4, yeah.
and I-6. And so we kind of cover that whole, we span that whole region of, central region of Florida, as well as in northern Florida, we just acquired a new asset in Tallahassee. We have our existing called legacy assets from 2019 when we really started buying larger institutional grade multi. And those are one of which we've exited, another 3 in which we're still actually doing very well on. All our deals are currently outperforming. We only have 2 or 3 deals that are floating or called bridge debt exposed to the current climate. Those 3 deals that we have, we were signed up at 190 plus SOFR, 200 plus SOFR. So we're pretty comfortable with our basis, and they're all low leverage at 65%. So from a lot of these are for family offices. They don't care for high octane debt. They don't care for high risk, the unnecessary risk. So we try to look at things for more of a low cost leverage. Where do we get the discount? And I think you'll see that a lot of deals today, at least in our industry, if you're taking an assumption with undesirable debt and lower leverage, tends to be that the seller will give you some sort of discount for that. So we see some opportunities there. We've also seen tremendous amount of opportunities start to come out on free and clear deals where we've never seen them before. Where deals that only really make sense with strong leverage points but don't have high cash flow going in place. Those deals are really struggling to sell in this market. So that's another advantage that we have in the marketplace. And then we have just inherent advantage being that we have over 250 high net worth investors at 250 minimum clips, check sizes, sorry. And then and then we have about 13 family.
It's a special purpose vehicle. It's not a fund.
SPV for every single deal separate. And we're actually in the process of structuring our GP fund, which is going to comprise of our strategic family office investors who've been with us for numerous years now. And they have a lot of value add outside of just putting capital into our deals. So that's part of what we're doing. And turn it back over.
So maybe we have about 7 minutes left. But so my question is, what's the catalyst for more home building? Is it federal government financing? Are the states going to have to become active? Because Florida can't support the cost of housing right now. You look at the incomes of people in Miami, and then the cost of housing is like 10x their income or more. Texas, Austin, Texas, maybe Austin. But I don't think Houston or Dallas can support it. Your thoughts?
I think it's a combination of land prices and carry costs. And back to the earlier comment about zoning, if it takes you 1, 2, 3, 4 years to entitle a piece of dirt, that's significant money. That's real money, right? So, and that affects the economics, right?
So before we build 1 million homes a year, and then after 2008, that collapsed.
The real statistic that I've read a couple of days ago, I'm not sure if my math is up to date, but if everything stays as is and we continue building the same pace we're building now, it's going to take us 18 and a half years to fill up the demand that's out there as far as housing. 18 and a half years.
The statistic we had in San Francisco was that there are 50,000 head of household jobs created every year there, and 5,000 units created every year for households.
So definitely not sustainable.
So the deal that we just bought was in Palm Springs in California, and Palm Springs is turning into a primary home market versus a secondary home market. And it's basically people move from LA to Ontario to San Bernardino, and they're now moving to Palm Springs.
Great place.
But to your point, it takes. There's only 2,000 lots. Available. In the horizon for the next 3 to 4 years, because it takes such a long period of time, particularly in California, to actually get stuff approved. What's interesting is California is doing some crazy stuff, which is, are you guys familiar with home equity option?
Deals? Maybe you can rephrase it.
So the new thing is, I need money to go and do a down payment or something like that. And rather than, if you have a low FICO score, you can go and instead of borrowing money through a home equity line of credit, people will go and invest as a TIC investor in your house. So they'll own 75.
It's like crowdfunding almost.
Yeah, except for the state of California is actually literally they just made a proposal to go and provide funding for people to make down payments on homes, which is only going to fuel the inflationary, I mean, the issue is not, it's a supply issue, right? Well, it's also a demand issue, but I mean, it's more of a supply issue than anything else. And if you have the state of California saying, hey, here's some free money, let's, we'll be an equity participant, I think that that's just going to continue to drive up prices.
They're an equity participant in a no equity real estate deal.
Correct.
Has California eliminated all zoning
Sense,
laws?
sense and reasoning? No,
Zoning, the single family zoning laws, aren't they eliminated in California now? Not yet?
Right, we have they opened up rules for these.
right, ADUs, so you have the ability to build,
ADUs, right.
to build rental properties in the back of your apartments. LA is becoming a big part of that.
But you also see population growth to where there's less zoning regulation to some extent. So Phoenix and Dallas and, you know, Austin, I think is land constrained, but Houston. So you see, you know, employers moving to those places where they can hire people at a lower cost of living. But then there's a trade-off between, you know, what's cheaper and what's nicer. And you're seeing that in places like Reno, Salt Lake City, Boise, you know, so you've got people who are higher tech who are going to places where they can work remotely. And then you have people who are going to places where employment growth is occurring because of the cost of living. So I think you're seeing all of that, but also, you know, that's, you know, West Coast versus Northeast versus Midwest, you know, different populations are going different places. So South Florida is beneficiary of the Northeast tax burden and the hedge funds and finance people, while as, you know, Phoenix is a beneficiary of a different demographic.
So we had Mayor Suarez speak at one of our events maybe 4 years ago, and in Miami, and he said that they intend to zone it. The way they intend to zone Miami is that they will be able to increase capacity by 9 times in terms of building apartment buildings. So I mean, so there's an area you should call Villa Havana, I don't know Miami, but Villa
Only one
Havana,
highway,
right?
only one highway.
And only one highway, right? And so they're rebranding Villa Havana to call West Brickell, but there's the Brickell Avenue is very nice. And now they're buying all these little houses and making massive condominiums on top of them. And,
Yeah, I mean, the problem with Miami
Suarez's plan is to make all of that, do 9x on the amount of population put in there.
part of the problem I've found with Miami is you don't have natural industry and you have a lot of flight capital, which sends inventory in spikes over like a 10 or 20 year period. So you get a lot of investment capital coming in, buying condos, renting them out. And then what happens when that contracts or the currencies shift?
But we have an attorney who speaks, who's you know, she does integration, and EV5 is half her practice, and she said that EV5 has built like everything off of Brickell since the last 10 years, since 2008.
That's basically.
I have a question, just a quick question.
Go ahead.
Do any of you do agricultural, like farmland and that sort of?
I think that's Bill Gates' question.
Hmm?
I think that's Bill Gates' question. He's the biggest owner of farmland, if you want to call him.
Like 75%.
I don't know, he owns like 70% of this country's farmland, yeah.
Good lord.
Yeah. Or so they say.
That was a mistake.
I don't know I don't know where they back that into. I don't know where that's sourced, but
Why?
That sounds wrong.
he's definitely the majority owner of land in the country.
The interesting play with the farmland stuff.
Individual.
We've seen a lot of distressed deals where it's almond farms in California converting to something that's less water intensive. And so you're seeing a lot of stuff where, you know, the need for capital to convert the crops I think it's an interesting play at the end of the day, but you know, California's water issues.
I would say California is going to be massively restructured because of the water issue. If you look at Lake Mead right now, and they ability to provide water to LA, it's going to be a big problem.
But
right?
they're
And
using
this water
people.
rights.
So we were talking about this outside. It was, I was in the Navy, so they have the technology. It's all over the Middle East, all over the world. Desalination plants, you know, it's just very capital intensive. I think they built a number in San Diego. The plan is just to right off the coast, so that you get California off the Colorado River.
It's also very energy intensive.
Desalination.
Well, but like anything else, it's new technologies and energy, they're very much better now than they were years ago. But you're right.
But Newsom was resisting that.
Yeah,
But isn't the
he's an
solution-
environmentalist, all that.
Solution
I
to the
mean,
water
what-
problem
do we have a
is
question in the back?
immigration from
Well,
California.
last question. I did have a question, by the way, somebody's selling their golf course in Hawaii.
Should we auction?
Last question.
Yeah, what are you underwriting to on a cash on cash return in this market?
So I think I'll answer that twofold. From a primary standpoint, I would say cash on cash is driven by, new assumptions that have to be revisited given the turbulent times, right? So, and then part of that is you're still solving for a cash on cash that's not too different from just a month ago, which quite frankly, it was maybe 3 weeks ago when deals were penciling and your cash on cashes weren't tightening up due to an adjustment of assumptions. So to go back to the primary part of the answer is really the cash on cash we're solving for has not tightened so much due to the environment. Rather, what we've had to do is adjust your disposition cap rate on the deal. We've had to adjust your growth rate. We've made it zero growth in all of our models, even though that you'd argue, how is that possible when there's continued growth right now? We've also hedged that by putting in lower leverage and talking to our lenders, in which we've become preferred borrowers with, that will tell us this is where we're going to end up executing. And we're able to now focus into just doing perm debt. We're no longer looking at floating rate debt into our portfolio, partly because we don't want to be further exposed portfolio wide, but also partly because we really don't know how volatile the interest rate market will become. And whether we're going to go with the doomsday guys of 8-9%, or whether we're going to go with the more kind of mainstream high 6s, low 7s, being where cap rates are headed, we basically have set ourselves, we have to adjust. We have to be in a higher going in cap rate in today's environment to build to not such a high cap rate. Because if you're banking on the same rental rate growth and also the same supplies and materials and labor costs, that's not happening because everyone else is getting squeezed. Our labor workers are the same guys paying the same $5-6 a gallon in gas tanks down in Florida. They're also getting hit on everything from food to basic essentials in their lives. So labor costs are going up, and at the same time, we're also hedging in higher contingencies. Whereas before we had maybe 10% of contingency in a more normal world, quote unquote. Whereas now we're putting in 15 to 20% contingency, and that's what we have to do in order to hedge ourselves from having to retrade on a seller, which we all know costs our reputation in the business.
So what cap rate expansion are you guys underwriting?
So we're usually we'll never underwrite less than a 100 to 150 bips spread on entry to exit. And typically today we want to see no less than a 4.5 to 5% entry cap on deals. Obviously, the newer the vintage, the cleaner the asset, the less deferred maintenance, so on and so forth, the more aggressive we'll get. But
and when you're building, what kind of spread are you targeting between going or stabilized cap and yield on cost?
So yield on cost, I'll answer stabilized cap. Usually from cap to stabilized cap, usually we want to see 250, where historically we would see 200 bips on the spread, because today there's a lot more room for error. So we build in an extra 50 bips to leave that room for error. And then in terms of yield on cost, historically we've been at a 6.25, anything above a 6 to 6.5% yield on cost year 5 or year 7, depending on your stabilization year within your hold period. But we basically set ourselves as a whole, we need to see now closer to 7.5. So it's no longer, the expectation of call it 100 bips delta from yesterday's yield on cost, to also yesterday's cap rate.
Right.
back to you, Marty.
Do you guys want to wrap it up with 30 seconds to a minute of what we should be thinking about as
You should never be asking for a real estate person to talk about 30 seconds on.
The old saying was never ask a lawyer to make a comment as they get charged by the hour.
Yeah, I think that if you're, I guess I'm the distressed guy. I think if you're anticipating the distressed market in terms of buying loans, I don't think it's going to happen until anything attractive is going to happen until probably second quarter of 2023. I do think that we're feeling optimistic that the bankruptcy market is starting, after 8 years of not doing anything in bankruptcy, we have probably 3 or 4 deals that we're looking at. So we're optimistic that that's an interesting market for us to play.
I'll pick up there and say, I think we'll see more stressed deals and more better price deals over the next year. My experience has been that the distress cycles, true distress, go faster and faster. And I don't see fundamentals in the economy causing a off the cliff like in 2008. So I think that there's great opportunity now in the more structured, more protected deals, and we're getting higher yields.
So you don't see any kind of real estate contagion?
Little ones, but not. I mean, real estate is so clubby. The deals and people work. A lot of people work stuff. So around the edges, yeah, sure, you'll see more of this and more of that. But there are high incentives for people to work things out, and you don't have a lot of big bankruptcies with high transaction costs. Bankruptcy code isn't favorable to single purpose entities going in. I mean, the GPs of the world are the exception, but I think that's played out in the last recession. I don't think we're headed down that slope.
Feedback on that?
Yeah, I mean, contrary to the GFC, as you said, right, we're not over levered. So I don't see a bubble bursting like happened back then. I'm by definition optimistic by nature, rather. So I would say overall bullish in real estate. I think it's a great inflationary hedge, depending on how you bet. You obviously have to stay disciplined and focus on the fundamentals, and choose your managers carefully and your sponsors and developers. But real estate is a cyclical business, and we're expecting a healthy cycle to come to close and a new one to open up, and that's creating a natural consolidation, cleaning out the weeds, so to speak. So a lot of players are going to get out of business. Some others are going to get in. In my book, that's a sign of a healthy ecosystem.
Yeah, I would definitely echo what you're saying there in terms of the low hanging fruit are going to be weeded out in this cycle, this part of the cycle. I think that the more sophisticated guys are going to be picking up a lot of this, a lot of the low hanging fruit that will be left in the marketplace. I also think in addition to that, the markets are heavily spoken for themselves in terms of regulatory bodies that did not exist in 08 to your point. Regulatory bodies as well as regulatory legislation, which hasn't existed, that came into effect post 08. So and also we've seen with the underwriting of real estate that they've bifurcated all the divisions of the banks in ways that was not the case pre 08, at least according to my mentors. I wasn't there at the time, but according to all my mentors, that but that's I can't. I'm not a person. I can't say I was in the business at that time, but definitely, it was definitely a learning curve for me from a historical lesson of stay judicious in your underwriting. Make sure that you're when times get turbulent like they are now, to be be more diligent in your underwriting and stress test everything. We used to do 2 to 3 case, base level stress tests. Now we're doing 5 or 6 on a given deal. So just to give you an idea, we're looking at things a lot more diligently, meticulously. And then last thing I would want to note is that it's going to be a time for private players with a lot of cash and powder who are decisive to pick up a lot of opportunities in the marketplace. So what we've done is we've started to structure our own fund and GP fund, as well as get all of our biggest family offices ready for this time that's coming. We don't know exactly when, we don't have a crystal ball, but it is coming. And so we're telling all of our family offices, guys, and investors as well, please be ready for this, because the time is coming and we've been waiting very patiently for this moment. So we appreciate you guys bringing up a certain amount of capital and letting us know what that capital looks like, and getting a picture of what their bandwidth is. So that's where we are.
So fantastic, guys, great. Peter, did you have a?
Yeah, no, just a quick point. I'm moving up so people can see me on the Zoom. So tomorrow morning, to give a teaser for tomorrow morning, based on work we do in the family office network and the government and other people involved, we have a member of the Ukrainian parliament. It's going to give us an update at 10:30, only speak for 5 or 10 minutes. So then you can appreciate the war is by far not even close to being over, but there's already talks about a government-private partnership to fund Ukraine to build it up over a period of time. So the Marshall Plan, for those of you that love American history and are familiar with that. So through some networks, we were able to get this gentleman for a few minutes. It's going to start at 10:30 sharp. Everyone can, obviously, they have much more important things to deal with in these conversations, but for those of you interested, if you can be ready at 10:30 and have the butter on the bagel and ready to listen to the conversation, that'd be great. And thank you, Marty, for allowing us to do this.